Hi everyone, excited to be here. My name is Vlad and today we're going to talk about raising capital, specifically about the financial aspects of raising capital. And specifically the financials of raising capital, how do you know how much to raise, what are you raising for, and how to leverage those funds to actually get to the next step of your fundraising journey. So before we start, I'll just do a 30-second presentation on myself and why. Originally born in Bucharest, Romania, in Eastern Europe, came to the States and had the opportunity to work at 3 different venture firms and 1 multifamily office. Did about 120 investments throughout that time, from pre-seed to Series B across North America, Europe, and Latam. Led 11 of those, sat on 3 boards, and also did a lot of angel investments on my own. So everything that I've done up until Flowly was early stage investing. And over the course of the last 3 years, I've been building Flowly Technologies, which I run right now, where we're building software technology to help raise equity or debt more efficiently without building a marketplace or a broker of any sort. So as we go into venture capital more broadly, I want to take a quick step back and kind of define some terms moving forward, because I think this is really important. Everything that I'm going to be talking about over the next half an hour relates to institutional venture capital. What I mean by that is VCs that raise money from LPs and then deploy that capital into startup. I'm not involving angels, family offices, corporate venture arms, accelerators, incubators, you name it. And the reason behind it is because venture capital as an asset class has a number of restrictions that are really, really important to understand. Those VCs raise money from LPs, they don't deploy their own capital. And in that exchange, they should return that capital back to those LPs with a profit over the span of 10 to 12 years. Meaning the moment you get capital from a VC, you're effectively on the clock to be able to return that capital forward. And because of that relationship between the GPs and the LPs, they have very strict mandates of what they can actually deploy that capital into. And you either fit in those criteria or you don't. And I know a lot of people, whenever they speak about fundraising, they mention all these things, the pre-seeds, the seeds, the Series A, Series B, without getting really concrete about what that means and how do you flow through that journey. And the metaphor that I've been using so far, and I promise we'll start our presentation in 10 seconds, is the idea of a train. And I do think it's probably the simplest way to explain it, is the moment you accept venture capital, you've effectively entered a train that has a very specific train track. And you may be able to refuel that train at the next train station. And in between, you're just going primarily through desert. Now, most startups die in that desert. A lot of startups die between pre-seed and seed, between seed and Series A, and you'll see a lot of reports when they call about graduation rates, how many startups actually make it to that next stage. And the reason behind this is because the people who invested seed have a mandate to invest at seed, the people who do Series A, they do Series A, and there's not a lot of stuff in between. So getting this right, in many ways, it's fundamental to building the right business. So we're going to go over a 5-step framework that I would suggest you think through as you're going through a fundraising journey, and a few pieces on how to implement as part of your pitch. So when you think about fundraising, usually the first question is, how much should I raise? And unfortunately, there's not an exact science to it. It's both a science and an art. But there is such thing as too little, meaning you run out of money before you get to that next station. You're caught in that desert land where you may have existing investors being able to do a bridge round and put a little bit more capital, but not enough really to get to the next step. Or you raise way too much, and then you have incredible expectation put on your shoulders to say, now you need to grow over the next 12 months, much more than you can actually operationally sustain. So there is a sweet spot in the in-between. Now, how do you think about this in-between? I would start thinking about it as milestone-based fundraising. So what do I mean about milestone-based fundraising? Well, step number 1, you define the milestone you want to reach. So you don't actually raise a pre-seed. You raise the capital you need to get to the seed stage. You don't raise a seed. You raise the capital you need to get to a Series A. And a close friend and very successful founder, he's currently on his 3rd startup, Series B, said it very nicely over dinner a few weeks ago. He said people need to understand that raising venture capital, and again, I mean institutional venture capital, not angels, family offices, CVCs, is a game of building the right company that the next set of investors are going to back, and so on and so forth until you get to an exit, be an M&A or an IPO. So that milestone has to be specific, and I'll give you some idea about what all the milestones are in today's market. Now that's changing, has definitely been changed a lot over the last 10 years, and specifically the last 3 have been seeing a lot of this. When we're looking at angel, friends, and family, As of right now, and we'll go over the valuations and stuff in just a second, I won't cover that right now, you must have built some form of MVP or prototype, and the money that you're raising is to validate that core concept, validate there's a market for it, validate that people care enough to make some money out of it. The pre-seed is raised out of the premise of, I've done that. There are some users, there's someone who's willing to give me some dollars for the product I have. In the case of a B2B enterprise sales motion, an LOI, MOU, like take everything that I say with like the grain of salt of industry, right? If you're building in space tech, you may not have 50 early users. If you're building consumer, 50 users is actually too little. So I'm using some averages here. And the goal of the pre-seed is to build that founding team, is to build a set of people that can take it and start forming that organization. The seed, as of right now, we're seeing somewhere between 500 and 750K of ARR in deals done. And where do we know this? There's a lot of reporting out there. We at Flow Technologies helped a little bit over 3,500 founders through a platform that is over 700 million. So we also have a lot of data ourselves. Mike is also here, our head of data science. So if you have questions about it, you can ask him afterwards. And that's what we're seeing right now in the market. 500,000 to 750K of ARR for deals that are actually done. And the goal of it is to demonstrate you have product market fit and that you can start scaling from there. The A started 2025 around 2 million. We're now seeing it moving up to about 2.5, and I wouldn't be surprised if we're ending the year at 3. We're actually having a conversation earlier today of the bar keeps on moving. And it's normal because the cost of building the startup is decreasing. And there was a great panel right before me where we talked a lot about how we can decrease that cost by leveraging AI, where we actually don't need humans necessarily to be involved in that early part of the process. And then the Series A promise is that we need to have a clear path to 10 million. So those are the milestones that you have to start thinking as you're going to market. From there, you build up a budget. And my background is accounting and finance, so I'll always go back to financials, but I won't suggest that as a pre-seed founder, you need a very detailed financial model, but you need enough of financial understanding to understand how your revenue compounds, how many users / contracts, at what ACV, at what frequency do you get in order to scale, how much that you can actually put in a pipeline, what would be a conversion rate that you're assuming to know that you're not just dreaming, but actually building a business. And also the expense side, how much do we actually need to spend in order to be able to build that. So obviously team cost, product development, go-to-market, all these things have at least certain assumptions about it. Now, there's a lot of tools out there. I would also argue probably Opus 4.7 is as good of a tool out there to give you some benchmarks of what startups spend. But start thinking, if I have that target and I want to reach that target between 12 and 18 months from now, what is actually needed in order to generate that revenue and what will be needed in order to spend to generate the revenue. So with that said, nothing goes according to plan. I think any founder in the room or anyone who's been around founders will tell you, you plan for something and usually there's a plus or minus 50% on any given day, up or down. So with that being said, there's 3 different points that I want to make here. One, it's runway extension. As we're looking at how long it takes to actually raise a round of capital, that used to be much shorter and now has started to increase over time. So for earlier stage, was looking at roughly 4 to 5 months of being in market raising capital, meaning time that you're dedicating as the CEO and the founder of the company to fundraising purposes and slightly less to your operational day-to-day business. If you're running a very operational heavy business and you can't have that time away from you, I would start thinking, how much capital do we need in order to have that buffer? Experimentation budget. We at Flowly have gone through a number of pivots until we landed to something that actually worked and got us to a lot of customers. We initially were building a due diligence analyst for VC and PE shops, nothing remotely close to what we're building right now. There has to be room for experimentation. Customers will come, you'll get new insights, and you'll realize that the best asset you have early on is the fact that you're nimble. And if you don't leverage that asset to see where the market takes you, you're making yourself a disservice by being too stuck on to the original promise. So that experimentation budget needs to be baked in. So 20 to 30% buffer is what we're seeing. Again, We're looking at averages. Nothing of this is, scientifically proven to the cent, so take all of this with some, grain of salt. And then you reality check against market ranges. And this is really the most important piece that I think a lot of founders don't get. So I'll spend a little bit more on this section. Going back to where I started the presentation about the idea of the institutional venture capital, funds that go to wealthy individuals, pension funds, endowments, etc., the LPs, raise money from them, do a handshake, an LPA, limited partnership agreement, and say, I will invest your money in this risky early stage asset class, specifically focused on fintechs in Louisiana. And that's my promise, I'll give you the money back in 10 to 12 years. That forms the thesis of the fund that they have the ranges to deploy capital in. That also informs, depending on the size of that fund, how many checks they can write, how many board seats they can take, how many partners they're going to have with that fund. There's a lot that goes beyond it. And funds spend a lot of time doing fund formation and fund modeling. As founders, when we're interacting with those investors, we need to understand those restrictions based on what we can genuinely ask them. You can be a really great performing company and ask for too little capital. And that may seem counterintuitive for someone, but as a fund, if I'm running a $200 million fund and my average check is $5 million, the initial check and I follow on, it makes no sense for me to write a $1 million check because I'm doing the same amount of due diligence to get less or more ownership in a company that may or may not be in the same stage that I want to get, and I just won't do it. It's too small of a round. Comparatively, it could be too large of a round. So as we're looking right now at angel, friends, and family, those are the 50 to 250K rounds, somewhere between 2.5 and 5% dilution. The pre-seeds, that's where we have the $500,000 to 1.5. And that's larger than it used to be. This is for the first time when we're seeing VCs participate, because VCs don't participate in friends and family, hence the name friends and family. And usually not as a lead investor. There's a lot of pre-seed funds that will write checks somewhere between 100 and 300K checks. Those are usually seed funds who are looking to get an early insight or data point or position in you. And there's some true pre-seed funds and obviously accelerators and incubators that's their main round. Seeds 3 to 7 and increasing, we're gonna take out some of the Bay Area from the averages because they will be skewed significantly. There's some really wild seeds happening out there. But on average, 3 to 7 million. And then the Series A is right now 10 to 20, again, on average, we're taking away some of the crazy outliers that we've been seeing in, obviously AI. So with that said, if you are at any of the points that we discussed earlier and you're setting those milestones, this is the bandwidth that you have of what capital you could be asking for. And you could be on the smaller side or on the larger side of that, you decide, but you can't be too much outside of those because you may have trouble with the foundational structure of the deal to actually get it passed to an investor. And as you're thinking through it, as you're going back to the original model that we just discussed, ask yourself, am I at the right stage? And do I want to enter or entertain continuing the VC train moving forward? The reason why I'm saying this, and I don't come here to say like don't raise venture capital, it can be great for a lot of different businesses, is that it's not for everyone. And you need to make sure that if you were to go on this journey that we've been just mentioning, that's the right founder and the right business for that. So as you're going out of this process and say, I've figured out where I am, I figure out what the expectations put on me will be. I understand with a good degree of certainty how much it will take and what it will take operationally to be able to get there and who I'm going to reach out to. You start having to think about some scenarios. And I would put 3 scenarios in these buckets, let's say. One is that we actually raise towards the higher end of what we hoped. That's great. There's a lot of cash. There's also a lot of expectations that now get put because the ownership stake that the investor took in our company needs to generate returns. And the larger the ownership, the more they're voting. If they take a board seat, the more their overall involvement in the company. By the time we reach Series A, founders don't have board control anymore. There's usually a seed and a Series A investor that have a board seat. Founder, if it's a solo founder, has one. or in some cases. Two, you start getting to a point of, I'm starting to lose a little bit of the reins of my business. So what if things go south? And that's what you're really trying to plan for. If we're raising at the higher end, how will it go? What else can we do? Can we generally meet those new thresholds? If we're raising our target, pretty simple, that was what we were planning for. But what happens if we raised less? And I think this is a conversation, or at least a question, that founders don't tend to ask themselves enough. And I go back to my train metaphor. If you're in the very early stage, pre-seed, your first round of capital, you still have a decision to make. I want to jump on the VC train or I don't. If I go out to market and I get commitments on a safe, let's say for $300,000, $400,000, and I know that the company that I'm building requires more or significantly more in order to get off the ground and get to the threshold that I need for a seed round, you still have a decision to make. Do I take the 400,000, I take the train out of the station, and I hope at some point I'll figure something out that will bridge me to the next seed round, or I find something else? Now, that something else depends on the situation of the founder. In some cases, could be raising family office or high net worth individual, if there are any of those connections, or if they're not working to develop those connections. It could be figuring out if it's an asset-heavy business, can some of those assets be financed using debt? And at that point, we don't need the equity to sustain it. Will we be able to adjust our promise and our business to be able to do more with less? But most important than anything, being realistic about it. And I would say it's genuinely upsetting to me whenever I see founders that have been, let's say, encouraged to take whatever capital was available to them, and they're now in this in-between, and quite frankly, a lot of those at some point are looking for ways to get their fundraising more simple, and eventually end up on our website and say, hey, we help with fundraising, but we're not magicians. We help make fundraising more efficient. Doesn't mean we're guaranteeing any form of outcome at the end, and I speak with a lot of them because that's customer discovery for us, and they say, well, we raised this, was less than we did, but we still did because the lead investor told us to do so. And now I'm here, I'm doing 200, 300K of ARR. It's not enough to sustain my burn. It's not enough to raise a seed. What do I do? And usually my answer to that, if I spend a little bit of time to understand the financials, is you started with a plan that was in the best case, which is we can spend on more engineers and more AI credits and probably get a designer and a PM as well, and maybe even a salesperson before we have product market fit. And then you quickly realize that you didn't have enough of a time or a buffer to get to that $500,000, 600, 700K, and now you have to scale back, lay off some people. It's never fun. Literally one of my close friends went through a restructuring 3 weeks ago, laid off half of his team before the Series A. Not fun at all, but the company now is profitable, even they're doing $5 million of ARR, great setup for Series A. They were just not able to continue doing what they used to do, because they raised a little bit less than they initially planned for the seed, and said, we have 12 months. 12 months pass, both slow and very fast in startups. And right now, 12 months used to be the advice that everybody gave, raise capital for 12 months. I would say that advice is changing right now to be 18 to 24 months. Meaning, if I were to design a P&L right now with whatever round of capital I'm raising, I would plan for roughly, ideally up to 24 months of runway before we desperately need capital again. Just gives you enough flexibility to figure some things out. So what do investors want to see? Everything that we talked so far is just helping you figure out about, one, is venture right for you? That's an answer every one of you should give to yourself and be honest about it. Second, okay, if I want to go the venture route, how much do I raise and from who, etc. So what do investors need to see in order to make an investment? And I'm being only focused on the structuring piece. Obviously, a great product and a great team and everything else that you hear from a lot of other speakers. So on the financials, credible milestones is by far the number one. Again, my background is accounting and finance, so I always had a little bit of a finance angle whenever I looked at deals, even early stage, seed and Series A. If you're looking at a model and it's absolutely bananas with like the craziest assumptions that you can think about, it only shows that one, you either have no clue what you're talking about, or second, you haven't spent more than a few minutes, instructing Claude to put together a model and then ship whatever it came. I need to understand from the perspective of founder, do you understand how revenue compounds in your company? What is the ICP? How many of those there are? What's the market size? What can you sell to them? What's realistic to start selling when you, the founder, are the only person selling in the company? How many of those you can sell in a month? How does that scale? Even over the next 12 months. I don't need a 5-year projection. I just need to understand there's some math behind how the revenue for next 12 months is going to look like and where it's coming from. The second part is a defensible budget, meaning, okay, we have that and I believe you. You may be able to generate that revenue. How much is it going to cost you to generate that revenue? And that goes from, we're going to hire a lot of salespeople to we're being very mindful and we understand what it means to run a startup and we try to plan for longer term runway rather than burn all our cash in the first 6 months and then be back at the same door asking for more money soon. So realistic hiring plan is probably the most important here because 90+% of your expenses are going to be payroll up until like Series A. It's genuinely very hard to spend money outside of payroll. In most startups, that becomes the primary driver, and payroll comes with hiring and training and management and a lot of other things. So have you ever run a team before? Do you understand what it means to manage a team? Do you understand what it means to grow a team? All these are coming to plan and usually get reflected. Even in a simple spreadsheet, you can sense if someone has done this before or never done it before. And then the last one is there a buffer? Is there a margin of error? If I go back and even if you haven't done, let's say, a cash projection, if I do a cash projection on top of your budget and I see that you're kind of almost cutting it very close, not great. Have you built yourself enough of a margin of error? So how do you use that to actually improve your pitch? And I do believe that this may be my biggest pet peeve as an investor. There were a lot of decks seen. In our busiest weeks at the multifamily office group, just because we were managing money for like a lot of different wealthy individuals, I would get like between 250 and 300 deals in the span of a week. That's like almost 1,000 over the span of a month. There's like a lot. So you end up reviewing a lot of decks. Now, a big number of those didn't listen to this presentation. And when you got to the ask slide, you would say, we're raising $4 million, and we're going to spend and hire 5 engineers and 2 salespeople and 1 person in marketing. Thank you for listening to this. Cool. And what exactly is that going to get you to? Right, going back to literally the first point, which is you have to have a milestone. The first thing that I do when I get to that slide, I'm trying to understand, does this founder understand what it means to take my money so that in 18 months, he can take someone else's money, which makes my money be worth more money, and that company still be alive. It's kind of a simple game at the very basic principles. We try to make it look very complex because there's a lot of money involved. It's pretty simple at the end of it. Company must stay alive, continue growing. Other people must put more money at a higher valuation, marks up our investment, makes our LPs happy. We can raise another fund because we have markups. Means we stay in business for another 10 years. We can do the same thing over and over and over again until one of those funds goes bust and then we lose our jobs. So with that said, you as a founder must entertain that. So going back to that slide, which I believe is really, really important, is don't just show the use of funds, show me how those funds actually translate into outcomes over what period of time, and make sure you understand that those outcomes are tied to a next financing round. This slide can also say, we're raising 5 million and we're gonna reach 100K of ARR in the next 24 months. And you may believe it, and that's great, but that will not allow you to raise the next round of capital, therefore not a great explanation, which is why everything that I just said, hopefully at this point starts making sense, that it goes back to your last slide in your pitch deck, your ask, and how you're eloquently explaining the use of funds to your investors. So why founders usually get this wrong? The biggest mistake that I've seen is raising on what they think they can get. And they can say, well, I'm based in Miami, I've seen the usual seed rounds in Miami, therefore I'll probably do that, and I'm in this industry. Cool, does not really change the game. You're all playing the exact same game, regardless of where you're based, regardless of who you are, regardless of your educational background, regardless of your gender, your skin color, your ethnicity, you name it. It doesn't matter. Like, any of these things, realistically, are irrelevant to the game that's being played. Meaning some people are going to have a crazy good advantage, AKA Silicon Valley and the Bay Area, and some people are going to be at a disadvantage. Doesn't change the game. So figure out what actually needs to be raised, what makes a great business, and then optimize for whatever that is. Now, copying industry benchmarks, I think, flows this into this pretty easily. Every business has unique needs. I've literally just said there's like a margin of error when we speak about B2B versus B2C, when we speak about software versus hardware, when we speak about specific types of hardware, like space tech, that's what I'm mentioning. Very, very different than building a gadget or a consumer hardware. For example, hardware early rounds, anything that's below a 4 million is usually not considered a venture round, a venture backable round. Meaning most hardware investors don't want to see having less than like 4 to 5 million in cash as you're starting a hardware company, because they understand how much capital intensive that is versus a software company where you're seeing pre-seeds even as little as $500,000. So that optimistic timeline assumptions, I was saying, it's getting longer and longer to raise. Again, for the 99.9% of us who are not in Silicon Valley and are building in like the coolest parts of AI or applied AI. So underestimate the time it takes to actually get the capital or hit those milestones, pretty big problem. And the last one about, again, forgetting about that buffer capital and unfortunately missing any form of projection that you're making and then being stuck in that desert.